Billionaires don't move quietly, yet their recent actions are louder than anything spoken publicly across financial networks. Their selling began gradually, then accelerated into a pattern too large to dismiss as personal rebalancing. More than $50 billion in assets have been liquidated across stocks, real estate, and private holdings. This level of selling rarely happens without a deeper signal forming underneath market headlines and political noise. The first clue appears in insider transaction records, showing wealthy investors exiting sectors once considered untouchable. These records reveal positions being reduced even during periods of market optimism and strong public commentary. The timing aligns with growing concerns about elevated interest rates, reshaping valuations across the entire economy. Higher borrowing costs pressure companies, pushing profit expectations downward while raising future refinancing risks. Billionaires understand the shift because many built fortunes by responding early to changing credit conditions. They monitor debt markets closely, watching yield curves steepen and liquidity pockets shrink beneath surface market rallies. When the cost of capital rises, leveraged assets become vulnerable long before ordinary investors feel it. This vulnerability grows when corporate credit spreads widen, signaling that lenders see increased future default risk. Billionaires interpret these signals quickly because they invest using long-term structural indicators instead of short-term enthusiasm. They see the strain building inside companies dependent on cheap borrowing during the last decade of low rates. Many businesses refinanced during near-zero interest periods and now face painful adjustments as those debts mature. If refinancing becomes expensive or impossible, earnings weaken and valuations shift even before markets acknowledge it. This dynamic triggers early selling among insiders who recognize the growing gap between perception and reality. Corporate executives also reduce their own exposure when internal forecasts reveal slower growth or rising operational expenses. Billionaires often rely on private data from multiple companies, giving them a clearer picture than public investors. This information advantage helps them identify pressure points forming beneath the economy's surface long before headlines shift. One major concern involves commercial real estate, especially office properties facing high vacancy and refinancing cliffs. Institutional owners began selling early, signaling long-term doubts about recovery in major metro office markets. This selling aligns with rising insurance costs, property taxes, and declining tenant demand in dense business districts. Billionaires see these issues as structural rather than temporary, prompting them to exit vulnerable positions immediately. Another warning signal emerges from slowing consumer spending across multiple income levels, not just lower-income households. Retail patterns show shoppers trading down, delaying purchases, and relying more on credit even for essentials. This shift pressures company earnings and increases risk across sectors dependent on discretionary spending. Billionaires respond quickly when consumption weakens because consumer activity drives 2/3 of the U.S. economy. A slowdown here often signals broader stagnation that spreads into employment, credit, and corporate profitability. Tech insiders also began selling after noticing valuations struggle to adjust to higher rate environments. Rising capital costs reduce the attractiveness of high-growth companies dependent on future earnings promises. Wealthy investors hedge exposure when tech valuations stretch far above sustainable long-term fundamentals. Liquidity becomes a strategic asset during such periods, allowing billionaires to remain flexible as volatility rises. Their cash holdings have increased significantly, showing preparation for buying opportunities during potential corrections. Uniformity in their actions reveals a deeper narrative forming across wealthy investor circles worldwide. When individuals with radically different portfolios behave similarly, it signals a widely recognized structural shift. This pattern also resembles early stages of previous downturns that insiders anticipated before official data emerged. Before the dot-com crash, insiders quietly trimmed holdings despite public optimism and strong market momentum. Before the 2008 financial crisis, sophisticated investors reduced risk as credit markets tightened unexpectedly. Current conditions share characteristics with both past periods, though driven by different economic forces. Today's catalyst is a worldwide transition away from cheap money towards structurally higher borrowing costs. These higher-cost pressure companies, households, governments, and financial systems at every level. Billionaires understand that markets built on cheap debt struggle when that debt becomes expensive. History shows that wealthier investors exit early to avoid being trapped in valuations tied to outdated assumptions. Their behavior doesn't reflect panic, but strategic preparation for a new economic environment, forming gradually. They reposition portfolios towards stability while waiting for markets to realign with new financial realities. Part of this repositioning includes heavy selling in luxury real estate markets across major global cities. High-end properties have seen increased listings from wealthy owners seeking liquidity instead of long-term holds. Real estate vulnerability grows when mortgage costs rise, construction slows, and institutional buyers pause acquisitions. Some billionaires reduce exposure to private equity ventures, where rising rates challenge leveraged acquisition models. Buyout firms reliant on heavy debt loads face major stress as refinancing windows become more restrictive. This stress appears in declining deal volume, higher borrowing spreads, and stalled acquisition pipelines. Billionaires selling early avoids losses that may emerge as private valuations adjust to new financing conditions. Geopolitical tension also influences their decisions, especially uncertainty around global trade and supply chains. Shifts in U.S.-China relations, sanctions risk, and energy market instability add layers of unpredictability. These external pressures increase the appeal of safer assets while reducing appetite for speculative investments. Billionaires anticipate that prolonged geopolitical uncertainty could disrupt earnings and suppress global liquidity. The bond market reinforces this concern through inverted yield curves, signaling slower economic momentum ahead. Yield inversions often precede downturns as investors seek safety despite short-term rate pressures. Billionaires track these signals because they reveal underlying stress across banking, lending, and credit markets. U.S. consumer debt has also reached record levels across mortgages, auto loans, and credit cards. Rising delinquencies show that households struggle to manage higher payments and persistent inflation. This trend threatens retail, housing, and service industries dependent on stable consumer finances. Wealthy investors reduce exposure in sectors vulnerable to demand erosion resulting from household strain. Corporate earnings projections now face downward revisions as companies adjust to tighter economic conditions. Billionaires who see early forecasts recognize when optimism no longer aligns with operational realities. Their selling reflects anticipation rather than reaction, based on forward-looking cash flow analysis. Some billionaires diversify internationally to hedge against U.S. market instability and political uncertainty. They allocate more capital into commodities, defensive stocks, and essential service sectors with stable demand. This shift suggests long-term caution and an expectation of prolonged market turbulence. Rising Treasury yields also force reassessments of portfolio strategies across high-net-worth circles. When safe assets offer higher returns, money flows away from riskier investments. This creates selling pressure in equities, pushing wealthy investors to rebalance quickly. Their fast movements often predict broader market trends months before average investors react. Billionaires have also noticed shrinking corporate profit margins, despite strong headline numbers. Inflation raises input costs, while consumers resist further price increases, squeezing earnings. This compression forces strategic selling as valuations no longer justify long-term optimism. These combined indicators form the foundation of the $50 billion selling wave now underway. It's not driven by fear, but recognition that the financial landscape has shifted structurally and permanently. Wealthy investors expect volatility, slower growth, and tighter credit conditions for years ahead. Their actions reflect preparation for opportunities that emerge only when markets reprice dramatically. Selling now enables them to wait patiently for moments when undervalued assets become available. This pattern historically precedes major market transitions that reshape investment strategies across decades. Understanding billionaire behavior helps reveal where the economy is truly heading beyond headlines. Their decisions may not predict exact timing, but they accurately signal approaching economic shifts. The $50 billion sell-off is not an accident or coincidence. It is a warning built from data, credit conditions, market structure, and experience accumulated over lifetimes. And it signals that the financial environment Americans see today is not the one they will see tomorrow. Millions watched billionaire behavior shift, but few understood what their sudden moves truly signaled. Their selling wasn't scattered or emotional. It was disciplined, coordinated, and unusually consistent across industries. The pattern revealed something deeper than portfolio adjustments or simple profit-taking during market volatility. Across filings, disclosures, and insider transaction reports, a structural repositioning appeared in real time. This repositioning emerged not from fear of recession headlines, but from long-term financial pressure building. The pressure reflected tightening liquidity, rising refinancing burdens, and shrinking margins across corporate sectors. When liquidity thins, the smartest capital prepares early, quietly repositioning before stress becomes visible. This is why billionaire selling matters. It reflects information understood long before the public notices. Insider transactions often reveal forward-looking expectations more accurately than analyst forecasts or market commentary. Throughout the last 12 months, insiders across technology, real estate, finance, and energy sold aggressively. These weren't isolated quarterly trims. They were sustained exits aligned with structural macroeconomic stress. The common thread connecting these sales was the rapid increase in corporate debt servicing costs nationwide. Companies financed heavily during ultra-low-rate years now face refinancing at dramatically higher interest expenses. This shift tightens cash flow, squeezes margins, and reduces corporate flexibility across almost every sector. Billionaires understand this pressure because they sit closest to the balance sheets absorbing these shocks. They see the numbers before ratings agencies update outlooks or banks adjust lending standards. Corporate insiders reacted by locking in gains, raising liquidity, and reducing exposure to overpriced equity. The selling concentrated most intensely in companies carrying significant leverage or refinancing obligations. Some insiders accelerated sales even when share prices remained strong, revealing deeper concerns underneath. Historical data shows insider selling often accelerates ahead of credit tightening and liquidity disruptions. In 2000, 2007, and 2021, similar patterns emerged months before broader stress unfolded publicly. Today's pattern shares traits with past cycles, but occurs under greater structural economic strain. Household savings are thinner, corporate leverage is higher, and government refinancing needs are unprecedented. This combination pushes systemic fragility higher, making billionaire behavior even more important to analyze. Their selling coincides with weakening consumer demand, reflected across retail, services, and transportation indicators. Earnings calls increasingly mention shrinking discretionary spending and rising default rates in consumer credit. These signals point toward broader weakness than headline unemployment numbers currently reveal. Insiders interpret these changes as early warnings rather than temporary fluctuations. When demand weakens while debt costs rise, profit compression becomes difficult to reverse quickly. Corporate leaders respond by raising liquidity before those pressures become visible to markets. Liquidity provides optionality during downturns, allowing companies to survive, acquire, or restructure strategically. Billionaires raise liquidity personally for the same reason corporations do: preparation. Preparation becomes essential when refinancing cycles collide with slowing revenue growth across multiple industries. The largest concern remains corporate debt maturing between 2025 and 2027, creating a massive refinancing wall. This wall forces companies to refinance trillions at significantly higher interest rates. Higher rates reduce cash flow available for investment, hiring, and expansion, further slowing economic momentum. Insiders understand this cycle deeply because they negotiate loans, review covenants, and monitor liquidity daily. They recognize how vulnerable some companies become when interest expenses double or triple within quarters. And these vulnerabilities rarely appear on the surface until pressure becomes unavoidable. Some insiders sold heavily within commercial real estate sectors already strained by declining occupancy. Office properties in major cities continue struggling from remote work trends and shrinking demand. Rising insurance costs, property taxes, and maintenance expenses compound these challenges. Billionaires with heavy real estate exposure reduced stakes early to avoid deeper losses later. Their selling extends beyond real estate into technology, where valuations remain historically stretched. High-growth companies relying on cheap borrowing now face constrained cash flow conditions. Insiders in those companies sold shares steadily as profitability timelines extend further. Energy insiders reduced holdings despite strong earnings, suggesting expectations of price volatility ahead. Across sectors, the theme remains consistent: reduce concentrated risk before conditions worsen. These moves indicate a shift towards safer assets, cash preservation, and diversification. Insiders recognize the Federal Reserve's limited ability to cut rates aggressively without reigniting inflation. Sticky inflation pressures restrict the central bank's flexibility, making rate cuts slower and smaller. High rates lasting longer create long-term strain across leveraged parts of the economy. Insiders prepare for this environment by prioritizing liquidity over aggressive growth investments. They also anticipate potential credit tightening as banks become more cautious lending to riskier borrowers. Bank stress tests show vulnerabilities under scenarios involving prolonged high rates and economic slowing. Insiders know credit availability affects everything from consumer spending to corporate expansion. When credit tightens, economic activity slows, creating feedback loops that intensify existing pressures. Billionaires prefer to reposition before these loops become visible in official economic data. Their advantage lies in timing, information access, and understanding of financial system mechanics. They trade based on structural trends rather than reacting to short-term market noise. This wealthy cohort has historically shifted behavior months ahead of broader market moves. Their selling today mirrors patterns seen before recessions and liquidity events in past decades. Insiders reduce exposure when asymmetry shifts: too little upside, too much downside. Current conditions reflect that imbalance more clearly than at any time since 2008. Leaders also factor geopolitical instability, supply chain fragility, and global debt pressures. These forces create uncertainty difficult to quantify through traditional valuation models. Uncertainty pushes capital towards safety rather than expansion, reinforcing billionaire selling behavior. Insiders also observe rising delinquency rates across auto loans, credit cards, and mortgages. These consumer stress signals reduce confidence in near-term economic resilience. When households weaken financially, corporate revenue ultimately softens, affecting even strong companies. Billionaires adjust accordingly, not waiting for recession confirmation before acting. They also understand government debt dynamics, including growing deficits and rising interest payments. Higher federal interest costs limit future stimulus capacity, reducing economic support in downturns. This creates an environment where downturns may last longer with slower recoveries. Insiders preparing early reflects expectation of prolonged economic cooling ahead. Some sell to diversify globally as emerging markets offer selective opportunities. Others hedge through private credit, distressed assets, or defensive sectors showing resilience. Across strategies, the consistent thread is repositioning rather than panic. Their actions reflect calculation informed by data, balance sheets, and forward-looking risk assessment. Investors paying attention to insider moves gain insight into where pressure is building. These insights often reveal structural issues long before economists adjust forecasts. Insider selling is not inherently negative, but its scale and timing matter. Today's scale and timing align with broader economic headwinds becoming harder to ignore. From slowing consumer demand to rising delinquency, each signal stacks atop another. Together, they paint a picture of an economy entering a more challenging phase. Billionaires act early because early action reduces exposure to compounding risk. Their behavior offers one of the clearest warnings available in modern markets. Ignoring these movements can leave investors exposed to risks insiders have already priced in. The clearest takeaway is not fear, but understanding. These shifts reflect structural transitions. Transitions require preparation, awareness, and strategic repositioning before stress becomes widespread. As insider activity continues, it signals rising uncertainty across multiple financial layers simultaneously. Those watching closely recognize this pattern as a precursor to broader market adjustments, and understanding those adjustments helps prepare for the turbulence ahead rather than being surprised by it. Billionaire selling accelerated further when indicators inside credit markets shifted in unusually synchronized ways. Liquidity conditions tightened sharply across several funding channels, normally stable during moderate economic slowdowns. Short-term borrowing costs climbed faster than anticipated, squeezing companies already dealing with elevated interest burdens. These pressures revealed themselves quietly, visible first only to those deeply embedded within financial infrastructure. Insiders recognize these signals quickly because they map closely to patterns present before past financial downturns. Corporate treasurers reported growing difficulty rolling short-term debt at previously available favorable rates. Private credit funds began adjusting risk models, raising required yields for borrowers across multiple industries. These shifts didn't appear in headlines, but they influenced billionaire strategy significantly and immediately. Insiders reacted because tightening liquidity often precedes more severe credit disruptions across financial markets. Tightening credit also restricts growth, reduces investment appetite, and weakens resilience across leveraged sectors. Billionaires positioned themselves early to avoid exposure to companies vulnerable under prolonged liquidity pressure. They recognized that leverage accumulated during cheap money years now posed considerable risk under new conditions. Companies reliant on refinancing cycles faced particularly elevated risk as debt maturity walls approached rapidly. Insiders interpreted this convergence of maturing debt, high rates, and softening demand as a critical stress point. Their selling matched the macroeconomic reality more than investor sentiment or market optimism. Markets remained relatively calm, but insiders saw what calm conditions often hide beneath surface levels. Corporate guidance quietly lowered expectations, especially among firms exposed to consumer softness or capital constraints. Billionaires selling reflected understanding that earnings compression becomes unavoidable under these overlapping pressures. Earnings compression reduces valuations, increases volatility, and reshapes investment priorities across entire sectors. Insiders anticipated this shift and acted accordingly, minimizing exposure before markets repriced risk broadly. Their behavior also reflected geopolitical risk considerations, including supply disruptions, trade tensions, and currency instability. Global uncertainty increases volatility, making liquidity even more valuable than traditional growth assets during unpredictable cycles. Billionaires often shift portfolios globally when domestic conditions become uncertain or structurally constrained. This shift influences capital flows, affecting certain U.S. sectors more than others in real time. Insiders move toward hard assets, defensive sectors, and cash-equivalent instruments offering strong yields. These moves reveal deeper recognition that financial conditions may remain restrictive longer than markets expect. Persistent inflation challenges force the Federal Reserve to maintain elevated interest rates to stabilize prices. Elevated rates reduce corporate margins, strain household budgets, and pressure governments through rising borrowing costs. Billionaires recognize how these dynamics constrain economic flexibility and reduce the probability of rapid recovery. They also understand the limitations policymakers face when addressing structural issues amid high deficits. Growing federal interest payments reduce fiscal room for stimulus that traditionally supports economic downturns. This limitation increases long-term uncertainty and encourages earlier defensive behavior among informed investors. Insiders monitor these conditions continuously, adjusting portfolios as structural risk becomes increasingly apparent. Their selling often reflects the earliest stage of portfolio repositioning before public understanding catches up. This stage emphasizes capital preservation rather than chasing increasingly uncertain market upside potential. Preservation becomes especially important when multiple vulnerabilities converge simultaneously across financial systems. Household debt stress adds another concerning layer insiders consider when making large-scale repositioning decisions. Delinquencies in auto loans, credit cards, and mortgages continue climbing steadily across income groups. These delinquencies reduce consumer spending, weaken revenue expectations, and further pressure corporate performance. Billionaires interpret rising delinquencies as early indicators of future economic slowing rather than isolated trends. They consider consumer strain a fundamental structural risk because it affects nearly every sector. Weak consumer demand undermines revenue, disrupts hiring, and dampens investment across broad economic categories. This combination contributes to the cautious approach reflected in insider activity over recent quarters. Billionaires increasingly emphasize diversification and liquidity as top priorities under uncertain economic conditions. Their emphasis influences capital allocation strategies among institutional investors, monitoring insider trends closely. Patterns show strong rotation toward defensive positions historically used before major economic downturns. These positions include utilities, healthcare, essential consumer goods, and specific categories within energy. The shift away from speculative technology reflects concerns over growth sustainability under restrictive financial conditions. Insiders gravitate toward environments offering stable cash flow despite macroeconomic slowdowns. Their preference sends quiet signals about expected challenges facing risk-heavy sectors in coming quarters. Another aspect influencing billionaire selling is tightening bank lending standards across commercial real estate. Banks exhibit caution financing office properties facing rising vacancies and declining valuations nationwide. Insiders connected to real estate portfolios reacted early, selling positions before broader repricing unfolded. This repricing continues today, pressuring balance sheets heavily exposed to distressed commercial assets. Insiders avoiding these segments reduce risk significantly while maintaining flexibility for future opportunities. They also observe weakening small business credit conditions, which often act as leading indicators. Small business stress reduces hiring, investment, and consumer spending across local communities. Billionaires note these signs because they often precede broader macroeconomic slowdowns. Another critical factor remains global capital movement shifting toward safer sovereign bonds outside the United States. Foreign demand for U.S. Treasury securities weakened as nations diversified reserves and defended currencies. Reduced foreign buying pushes more debt absorption onto domestic institutions facing their own pressure. This dynamic influences billionaire sentiment because it affects long-term interest rate stability. Higher borrowing costs across treasury markets spill into mortgages, corporate loans, and business credit lines. Insiders understand the structural impact rising yields have across nearly every economic dimension. These conditions influence their decision to sell risky assets before systemic weakness becomes widely recognized. They also analyze corporate inventory levels, shipping trends, and energy consumption for early signals. Recent data shows cooling demand across freight, manufacturing, and consumer discretionary categories. These patterns historically align with pre-recessionary conditions, reinforcing billionaire caution. Another layer involves volatility in global commodity markets affecting production costs and profitability. Companies exposed to commodities face unpredictable swings, impacting both planning and pricing strategies. Insiders anticipate margin compression in these sectors, prompting strategic selling before valuation adjustments. Their insight doesn't require forecasting catastrophe, but recognizing asymmetric risk skewed heavily downward. When upside shrinks and downside expands, capital flows defensively with strong consistency. This defensive shift mirrors patterns seen before significant market resets throughout modern financial history. The timeline varies, but insider positioning remains highly predictive across long periods. Billionaires rely on this predictive power to avoid compounding risk and protect wealth. Their selling today represents the most coordinated insider activity since several notable periods of instability. These include the dot-com unwind, the 2007-2008 credit buildup, and the high valuation unwind preceding 2022 declines. Patterns align not because circumstances match exactly, but because underlying dynamics share important similarities. Those similarities include inflated valuations, tightening liquidity, elevated leverage, and weakening consumption. Insiders act early because they see the system approaching stress points ahead of broader awareness. Their actions also reflect expectation of slower economic growth potentially lasting longer than recent cycles. Longer slowdowns require stronger liquidity positions, reduced leverage, and diversified asset bases. This preparation explains large-scale selling, even when indexes remain relatively stable. Insiders trust hard data more than temporary market optimism influenced by sentiment or momentum. Data showing slowing loan growth, rising delinquencies, falling savings, and tighter liquidity shapes their behavior. These data points collectively represent a market preparing for adjustment rather than expansion. For average Americans, these billionaire moves offer insight into where the economy is heading. When insiders sell consistently across sectors, it often reflects deeper issues behind market performance. Those issues expand slowly before accelerating into broader market pressure affecting households nationwide. Understanding insider behavior provides a window into early signals before official data catches up. It allows observers to anticipate shifting conditions even when headlines remain optimistic. This anticipation becomes essential as the economy transitions into more uncertain territory. Insiders are not predicting collapse. They are preparing for prolonged instability and muted growth. Their strategy reflects caution, discipline, and recognition of risk multiples across financial systems. This disciplined repositioning marks a structural turning point inside markets, signaling deeper adjustment ahead. And those signals, visible through billionaire selling, form one of the clearest warnings available today.